I've repeated this many times, and it stays true every time. The most important principle of compounding is simple. Don't break it for no reason. And the quickest way to sabotage compounding is by losing capital. It sounds almost childish to say, like warning someone not to grab a burning coal, yet the world is crowded with people who ignored that warning and got scorched. I've been involved with investing longer than most people have been alive. I've watched booms inflate, then implode, then revive only to fall apart again. I've seen brilliant minds end up penniless and ordinary folks slowly build fortunes. And if I had to compress everything I've learned into one core truth, it's this: the winners are usually not the ones who chase genius, but the ones who consistently dodge foolishness. Let me illustrate. In the 1930s, when I was a boy living in Omaha, the Great Depression wasn't a lesson in a classroom, it was the air we breathed. Men who once held respectable jobs were selling fruit just to feed their families. Homes were being repossessed left and right. You could buy quality farmland for the cost of a beat-up automobile. The message was painfully clear. If you borrowed money and the environment turned against you, you got swallowed alive. If you kept your footing steady, you made it through. I saw households crumble, not because fate was cruel, but because people were overly confident. They believed tomorrow would mimic yesterday. They were wrong. That era permanently removed whatever faith I had in widespread rational behavior. Humans forget lessons far more quickly than you'd hope. Jump ahead to the 1970s. Inflation was devouring savings. Equities collapsed. Oil costs went through the roof. And again, plenty of supposedly sharp operators were wiped out because they leveraged too much, trusted too easily, and behaved as if wealth owed them something. I wasn't any sort of prodigy. I was simply careful. I kept clear of unnecessary debt. I ignored market gossip. I refused to chase the latest financial fashion. And because I stayed away from catastrophic losses, compounding kept working quietly for me. Year after year, decade after decade. It can't be said enough, avoiding ruin matters more than landing jackpots. People dislike hearing it. They want the thrill of spectacular returns, the fantasy of turning a small stake into a windfall overnight. That craving has destroyed more fortunes than hardship ever has. Look at the gamblers in Nevada. The neon skyline isn't funded by winners. It's paid for by people convinced they cracked the code. Financial markets operate on the same principle. The casinos are just larger and dressed in suits. I once put money into a company that looked like a dirt cheap steal, a classic leftover cigar investment. A final puff of value, maybe something for nothing. Sure enough, I got my puff, but the smell lingered for years. That experience cured me of buying garbage, just because it looked discounted. Low price doesn't transform trash into treasure. That blunder cost me more than I like to recall, but it delivered a better lesson than any university course. Preventing stupidity costs a tiny fraction of what it takes to correct stupidity afterward. If you want to safeguard your wealth, start by eliminating the obvious threats. Don't take loans you can't handle. Don't place money into businesses you don't genuinely understand. Don't rely on people who profit by selling you predictions. And don't ever assume you can outwit an entire market. You can accumulate significant wealth simply by enduring. Warren and I never went hunting for fast riches. We focused on staying solvent. That small shift in priority becomes enormous over time. So here's the simplest guidance: skip trying to look brilliant. Forget being the cleverest voice in the room. Limit your foolish errors. That alone can make you wealthy. And if that advice bores you, feel free to chase the next shiny stock. The market won't stop you. It'll gladly accept your contribution. If you want to wreck both your finances and your happiness, envy will get the job done quicker than any crash. Envy is the most ridiculous vice of all. Why? Because it doesn't give you a single moment of pleasure. Lust can be fun, overeating at least tastes good, pride can feel sweet for a while. But envy, it's self-inflicted poison while waiting for someone else to suffer. I've watched people earn respectable incomes, live comfortable lives, and still be unhappy because someone around them got ahead slightly faster. A nicer vehicle, a larger home, a quicker rise in net worth. Suddenly contentment evaporated. That mindset pushes people into reckless behavior. Instead of following sensible principles, they copy whatever trend appears to be working for someone else. Tech names in the late 90s, real estate before 2008, cryptocurrency mania in 2021. Different timeline, identical error. Warren and I rarely bothered with envy. We didn't care if someone else doubled their money while we sat on our hands. We understood that doing nothing with a great asset often beats frantic activity. It's not glamorous, but it's true. During the dot-com craze, everyone was boasting about internet plays. We looked like dinosaurs for refusing to join in. Plenty of those stocks multiplied tenfold within months. Our acquaintances felt flush with paper wealth while we seemed outdated. But a few years later, most of those paper piles vanished, and our slow, quiet compounding kept rolling forward. Envy cost those folks vastly more than any downturn. They tried to sprint past competitors, but ended up running off a cliff. Envy doesn't just devastate bank accounts, it ruins peace of mind. I've met wealthy individuals who couldn't enjoy their boats because someone else's was a tad bigger. That's not living, that's imprisonment. One line I've always liked says, "Someone will always be getting richer faster. Who cares?" That mindset keeps you grounded and sometimes even keeps you alive financially. Most envy-fueled choices appear genius level for a moment. A streak of luck, a bit of bragging, a brief illusion of superiority. But once reality shifts, the mask comes off and suddenly you're exposed. Broke, embarrassed, and wiser than you hoped to become. You don't have to outpace every competitor. You just have to avoid losing everything. The person you're jealous of today may be insolvent tomorrow. And if you act rationally, you'll still be on your feet. So the antidote to envy is straightforward. Stop checking the scoreboard. Stick to your own lane. Investing is a long-distance event, and most participants drop out before the finish. Your job is to stay upright by not tripping over your own blunders. That's how you win, not by mimicking the careless. I've made my share of mistakes, some minor, some painful, and a couple that probably cost a staggering sum. People like to imagine Warren and I sitting in a perfect office making flawless decisions. That's a fairy tale. We messed up like everyone else. We just made sure the errors weren't catastrophic. One regret that lingers is underestimating how extraordinary certain businesses would become if we had simply let them compound earlier. We passed on companies that seemed pricey at the time. Coca-Cola before our eventual purchase, for one. Missing the earlier opportunity didn't ruin us, but the potential return we forfeited was massive. Many investors fall into that trap, obsessing over price while ignoring quality. Buying low-grade companies just because they seem cheap, or refusing to pay a fair price for excellence. Both mistakes drain far more wealth than people realize. Here's another memory. I once invested in a company that fit the discarded cigar metaphor. The valuation looked like a steal. I figured I'd squeeze one more puff out of it and be clever, but the business itself was decaying. After some initial gain, the problems surfaced, and I lost both money and valuable time. That was the last time I chased such scraps. Bargains that look too good usually carry a foul aftertaste. You're better off paying reasonably for an exceptional business than snagging a cheap dud. I can already hear young investors protesting about overpaying. But here's the truth: overspending slightly on quality is far safer than buying trash at a discount. Trash disintegrates. Quality snowballs. To be clear, we didn't toss money at absurd valuations just because we admired the brand. But when we saw a truly durable, moat-rich enterprise, we stopped being overly clever about price. That lesson cost a fortune to learn, but it was worth every dollar. The real payoff isn't in perfectly timing purchases or sales. It's in waiting on the right business. Time harms weak companies. Time turbocharges strong ones. So when someone asks what my biggest investing mistake was, I often reply that it wasn't the losses. It was the gains I never earned because I underestimated the obvious. And if you're trying to avoid losing money, don't just stay away from disasters. Avoid wasting years on mediocrity. Slow erosion takes more from investors than crashes ever will. Markets punish impatience, but they also punish bargain hunters who think a low sticker price matters more than business strength. It doesn't. In this arena, you don't get compensated for dazzling cleverness. You get rewarded for avoiding chronic stupidity, realizing that early is worth a fortune. And if you're wondering why most people fail in investing, the culprit isn't misfortune. It's arrogance. People assume they know far more than they actually do, and they act on that illusion. I've watched individuals sit in meeting rooms convinced they could bend reality. They'd proclaim things like, "This time is different," or "The old patterns no longer apply." Every time I heard statements like that, I knew a train wreck was on its way. Confidence is useful. Hubris is deadly. Most people don't grasp how narrow their true expertise is. They skim a few articles, chat with a broker, watch a pundit, and suddenly believe they've mastered industries that take lifetimes to understand. People don't realize how fast wealth can slip away, and the only reason Warren and I managed to hold on to ours is because we were always willing to admit what we didn't understand. It's not glamorous, and it certainly doesn't sound impressive, but recognizing your own blind spots is one of the strongest advantages you can have as an investor. Take the airline business, for example. We steered clear of it for ages because everything about it looked like a graveyard for capital. Endless fixed costs, volatile demand, tough labor dynamics, expensive equipment, and constant exposure to fuel prices. We knew we weren't sharp enough to predict which carriers would survive that storm, so we simply avoided the whole sector. That single act of restraint spared us from decades of wealth destruction. Eventually, we dipped our toes in, thinking the industry had matured. That was wishful thinking. The fundamentals didn't shift, we just relaxed our discipline. Luckily, we didn't commit too much, so the losses were small and easy to walk away from. The bigger point is simple. When pride makes you think you're infallible, you start taking swings you shouldn't. When you acknowledge what you don't know, you stay alive long enough to win later. One of the most dangerous thoughts in investing is, "I can't mess this up." The moment that idea enters your mind, you're already in trouble. Look back at the tech mania of the late 90s. Everyone suddenly believed they had a golden touch. Students were trading stocks between classes, cab drivers were preaching market wisdom, and people convinced themselves earnings no longer mattered. That madness was nothing more than overconfidence dressed as innovation, and it collapsed exactly the way delusions always do, in flames. I have no problem looking cautious for steering clear of something I don't fully grasp. What does bother me is making a big wager on something I never understood to begin with. The antidote is humility. Not the kind where you act humble outwardly while secretly thinking you're a genius, but the kind that admits uncertainty and stays within its limits. That's the real way to avoid permanent loss. You don't have to have a viewpoint on every industry, asset class, or global event. No one needs your take on cryptocurrencies or foreign interest rates if you don't truly understand them. Silence and patience often protect capital better than flashy opinions ever could. Another major reason people sabotage themselves is because they think like employees instead of owners. Employees obsess over the next review cycle or bonus check, while owners care about the long-term health of the enterprise. That kind of short-term mindset leads managers to prioritize their careers over the company's future. I've watched executives drone on about vision and strategy, while privately obsessing over their stock options. That mentality is why corporations announce massive buybacks near market peaks, and then slash spending when opportunities are cheap. Warren and I always approach decisions with the next 2 decades in mind, not the next quarter. Consider our purchase of See's Candies in 1972. Analysts at the time insisted we had paid too much. If we'd been thinking like typical executives worried about headlines, we might have backed out. But we viewed it through an owner's lens. Solid brand, loyal customers, durable competitive strength. 50 years later, that so-called overpriced acquisition turned out to be a treasure. Contrast that with many corporate leaders who chase acquisitions, not because they're good deals, but because they inflate the size of the empire they control. which boosts their prestige and paychecks. True owners look at return on capital, not how big the company looks on a chart. The same story played out in newspapers. In the mid-20th century, they were incredible businesses. Then the internet appended everything. A genuine owner would have worked to adapt, preserve the moat, and rethink the model. Careerists simply coasted until they could retire comfortably, leaving shareholders to absorb the blow. Whenever you analyze a company, ask yourself whether the leaders behave like stewards or like climbers. Stewards endure short-term pain to ensure long-term strength. Climbers sacrifice the future to look good today. I've watched incredibly talented teams build wonderful products, only for quarter-driven management to derail the whole thing. Meanwhile, simple, steady businesses led by disciplined owners compound into empires because they focus on customers rather than publicity. So when you invest, don't get distracted by spreadsheets alone. Pay attention to incentives. Incentives tell you everything you need to know about how a situation will unfold. Bet on people chasing career points, and you'll see your capital vanish. Bet on owners, and you'll likely be rewarded if you're patient. Markets can seem complex, but most of the time they're just human behavior writ large, and people haven't changed much over the centuries. Careerism erodes, ownership builds. Choose the latter if you want to hold on to your money. If you want to understand why I emphasize avoiding large losses, you have to go back to my childhood during the Great Depression. Growing up in Omaha in the 1930s wasn't education. It was witnessing hardship firsthand. You could observe risk simply by walking down the street. People who had stable jobs lost everything overnight. Entire families were forced out of their homes, and kids wore the same worn-out clothes year after year. I saw what happens when people stretch themselves too thin and the world suddenly collapses on them. Debt destroyed lives. Folks borrowed assuming tomorrow would resemble yesterday, and when reality shifted, they had nothing left. Those memories never faded. They made me deeply wary of leverage, speculation, and optimistic assumptions. Life can turn on you quickly, and if you're not protected, you lose more than money. You lose self-respect. Then came the crash of 1973-74, the worst bear market since that era. Stocks were cut in half, and once again the people who borrowed heavily suffered the most. The ones who survived weren't necessarily smarter. They were conservative. The Depression also ingrained in me an appreciation for cash. In boom times, holding cash looks timid. In crisis, it becomes ammunition when others are helpless. Many fortunes are built by people who had dry powder when panic made prices absurd. That's exactly how Warren and I operated. We never apologized for sitting on cash while others rushed into expensive assets. We waited until fear created bargains and then acted decisively, another habit shaped by my early years. I also learned that durability is more important than brilliance. I've watched bright, talented individuals get wiped out because they never prepared for downturns, while modest, disciplined families came through intact. These days, people idolize high-risk, high-velocity strategies, but I saw how that mindset ended for those who believed the future was guaranteed. They wound up broken. That's why we stressed endurance. Your IQ doesn't matter if you can't withstand adversity, and adversity always arrives unannounced. One day you wake up and half the market is gone. The Depression wasn't just a chapter in a history book for me. It marked me. It imprinted one overriding rule: never suffer a loss so large that recovery becomes impossible. Small setbacks are fine, but catastrophic ones end the game. That imprint guided me for a lifetime, and it's a lesson worth borrowing. If you're determined to stay wealthy, or at least avoid ruin, be cautious of three enemies: debt, turmoil, and foolish companions. Debt is a silent threat. Even responsible people can be destroyed by it when the unexpected hits. I've seen that pattern repeat from the 1930s to the 1970s.